Hey everybody, A Bissen here, and today we're going to be talking about how to get your credit scores up the right way after you've had a negative event on your credit history. And by negative event, I'm talking about the small stuff and the big stuff. And by the small stuff, I'm talking about if you've had a medical collection, or if you've made like a 30-day late payment on your car note, or by big, I'm talking about like a foreclosure, a bankruptcy, a short sale, or a deed in lieu of foreclosure. So in this video, we're going to be covering the top 2 mistakes that I see people make time and time again after they've had a negative credit event. And of course, we're also going to be covering the right way to get your credit score up dramatically and to insulate yourself from future credit issues. So mistake number 1, running away from credit completely. That is actually the worst thing that you can do, because eventually, if you want to make your major purchase, such as an automobile or a car, you're gonna need a loan of some sort, right? So that is the biggest mistake. And also assuming that by running away from credit, your credit score is gonna get better. Your credit score is actually based on an algorithm of your most recent credit history. So if you don't have any recent credit history, your reputation kind of leaves off where you left off with your credit. Mistake number 2 is paying off collection accounts that are not necessary to pay off. Now, first, we're not talking about the ethics around this or the legality of this. We're strictly talking about whether or not paying a collection account will improve your score. That's the goal of this video. Now, we're also not talking about government liens or judgments. Those must always be paid. Now, once a creditor sends you to collections, the bulk of the damage to your credit score has already been done the day it hits. So if you pay them off or you negotiate a lower payment with them, that may help you if a lender is requiring you to pay that off, but it doesn't necessarily mean that your credit score is going to improve. And in my experience over the years, it's the exact opposite. It just doesn't help at all with your credit score itself, which is the goal of our video here today. So once one of these negative events has happened, obviously your credit score, as we discussed earlier, is not going to get any better on its own. So in order to get it better and make it higher, you need to create new trade lines or create a new credit profile or new credit history to replace the old credit history. So here's how you do that. And by the way, it's probably a lot easier than you think. Just before we get started, I want to discuss just a couple of quick terms so you understand them. Number 1 is the difference between secured credit and unsecured credit. Unsecured credit is something like a credit card. You sign an application, you put your signature in, and the credit card company gives you a line of credit. Or you get a signature loan. You sign and pledge your reputation that you're going to repay this loan. Secured is an alternative form of credit where you give the collateral to the bank in advance, and then they give you a loan for the equal amount. For example, you give a bank a $1,000 cash deposit. They'll place it in a savings account and place a hold on it, but they'll also give you access to a line of credit or a loan for $1,000. So now that we covered the basic terminology, here are the steps you're going to need. You're going to need 2 credit cards and 1 installment loan. Here's how to get that done. So let's start with the credit cards. First, you're going to go to your bank or credit union and you're going to apply for a credit card. Try unsecured first, which is the standard application. And if they say no to that because of your credit history, then you can ask them if they have a secured credit card program that you can apply for. Now, once you've achieved the goal of getting the card, you need to manage it in a very specific way. And this is the most important part. Credit cards can do one of 3 things. They can help you, they can be neutral, or they can harm your credit rating. So the goal here is to improve your credit. So you need to maintain a balance somewhere between, say, $20 or $50 and up to about 40% of the available limit that the bank gives you. Don't go over 40 and certainly don't go over 50. The higher over that you go out of positive territory, and if you start maxing your credit card out toward its limit, regardless of whether you're making the payments or not, it actually has a negative effect on your credit. So make sure you keep that balance in that little sweet spot. If you're the type of person that takes credit, spends things, and then immediately turns around and pays it down to 0, then you are actually kind of spinning your wheels. It's not harming you, but it's not helping you. You need to maintain some sort of balance on that card. You can run anything you want to on that card. Gas, groceries, household expenses, whatever they may be, but If you're the type of person that likes to pay it down to 0, try paying it down to 100 and making 100 your new 0. Okay, next step is the installment loans. Now, you're going to walk into your bank or credit union and you're going to request a signature loan. If they say no to a signature loan, ask if they have a secured program. That's, again, just like the credit card. You're going to be giving them money in advance, and then they are going to be giving you a loan for the exact same amount of money. When you get that loan, whether it's secured or unsecured, you're going to take the proceeds for that loan, and above all, do not spend that money. That is not money for spending, that's money for saving. Here's what you're going to do. The day after you get that loan, you're going to go ahead and set the money from, or the proceeds from that loan, and put it into a separate savings account. And then you're going to instruct the bank to pull your monthly payments out of it. You can set that loan up to be repaid in, say, 18 to 24 months is typical for this purpose. You take the proceeds, you put it into the savings account, and you have the payments drawn out of there automatically. It's an automatic pilot. You don't even have to think about it. So once you walk out of the bank, you're going to create a calendar event on your phone, Google Calendar, or your iPhone calendar, whatever follow-up system you feel most comfortable with, and you're going to set yourself a reminder that begins 9 to 10 months from the date of the first payment on that loan. That event is going to be your payoff. It's served its purpose. It's created a new trade line on your credit history to help build good payment history. Now, if you want to keep it for a little bit longer than 9, 10, 11, 12 months, you're more than welcome to. Now, after you've paid it off, rinse and repeat. You can actually go back and do it again. And each time you do it, you can request more, or if the bank wouldn't give you an unsecured loan last time and you had to go the secured route, this next time they may be willing to give you a signature loan for the second time. So as time goes on, the more often you do the installment loan program, it's building more and more credit depth. And that's really the key to getting yourself into the high credit score ranges that you really want to be in. So I hope you found this helpful. These are techniques that have been tried and true over time, and they really do work. The more you stick to it, the better it works. And the biggest part is actually taking the first step. So once you get these types of things in your financial sphere and you keep working these, they become a habit. And over time, those habits build enormous credit depth. And that's where you're going to see your credit scores really skyrocket. So again, the first and most important advice that I have for you is make a plan, write it down, and get started. You do that, the sky's the limit. Thanks again, and have a great day.